Hello, good morning. Welcome to today's morning market call. My name is Ian Joseph, lead market analyst at HFM. Now, a quick disclaimer before we do begin: the information herein is only meant for educational purposes. None of it should be construed as investment advice. Now, trading the financial markets do carry a degree of risk to it, and please do your due diligence and let's get it on. Today is going to be very active in the financial markets. Let me pull up my screen. Starting off with the economic calendar, this is where we generate most of our ideas. Now, if you go to the HFM website, you can go to tools and education under economic calendar. Here it is. On the exclusive analysis, we do have the economic calendar and the earnings calendar. We are going to start with the economic calendar. This is whereby we are going to generate most of our ideas that we are going to look at in the financial markets. Now, today has been very active in the markets, starting off with JPY, whereby they did release their corporate service price index. And now this is very interesting. Let me pull up my chart here because there's a few information that I seem to be lacking that did happen earlier on in the day. Jolly good. Now, today in the morning, we did have Fed Williams' speech, starting with Fed Williams' speech. And this was very interesting. He's the head of the New York Central Bank. Now, Fed Williams, he did not comment on monetary policy outlook in his speech earlier on today. And this comes at a very interesting time because he did mention that we are still in the era of low neutral interest rates, or the R star as it's known. Is not over pointing to long-term demographic and productivity trends that continue to suppress underlying rates. Speaking in Mexico, Williams noted that growth adjusted R star estimates for the US Euro area, the United Kingdom, and Canada remain around 0.5%, similar to pre-pandemic levels, which is quite interesting, noting that he acknowledged that estimating R star has been complicated by recent shocks like pre-pandemic driven inflation and aggressive global rate hikes, but stressed that structural forces still does point to a persistently low environment. Williams did caution policymakers not to put too much weight on the precise R star estimates. Now, once again, the R star estimate is whereby the central bank, remember, the purpose of a central bank is to maintain full employment and inflation below the 2%. Now, the R star is deemed to be the perfect balance between interest rates are not too high and interest rates are not too low to provide a suitable economy for both investors and consumers in a particular economy. Now, this is very interesting because we want to listen to the tone of these people. We want to listen to the tone of the Fed Reserve, whereby we do anticipate they're going to have an interest rate hike. Interest rate reduction, especially coming from Jerome Powell last week, whereby he did hint at, yes, we are going to see the rate cuts very soon, but by how much, we are still in limbo. And we want to listen to the Fed Reserve's data and digest this information. What does it mean for us institutions? What does it mean for us traders? Does it mean we are going to buy or sell the dollar more? And we are going to go into that in just a moment's time. Now, the speech was exactly 2:15. This is Nairobi time, GMT plus 3. Now, at exactly 2:50 a.m. in the morning, we did have JPY releasing their corporate service price index. Now, this is very important because when you look at the Japanese economy, technically they're more into service. They do export more than they do import. Now, when you're looking at the services, this data is going to look at, okay, how did these people, now it's released by the Bank of Japan, which measures the prices of services traded among companies. Let's say, for example, Toyota selling to Hyundai and so on and so forth. It represents prices developments that reflect most sensitively the supply and demand conditions in the services market. It's also considered as an indicator for inflationary pressures. Normally, a higher reading is seen as positive or bullish for the JPY, while a low reading is seen as negative or bearish for the JPY. Now, when we look at the data, this is the data that was just released, whereby now, whenever you're looking at this data, there's usually two sets of data that will be released, the core, and then we are going to have the data itself. Now, the services PPI, this is the document that was released by Japan at exactly 2:50 a.m. in the morning. As you can see, this was 8:50 a.m. Japanese time, okay? So this is from the Research and Statistics Department, Bank of Japan monthly report on the services producer price index. This is essentially the same as the PPI data for the United States of America. Now, looking at this piece of information, the Services Producer Price Index, all items rose 2.9% from the previous year, which is good. We want to see this data move to the upper side, meaning that producers, okay, you sold 2.9% more this year at this specific point in time compared to last year. Now, the Services PPI Index, excluding international transportation, remember, once again, the Japanese economy is known for producing mass production vehicles. When you look at the vehicle in front of you is a high probability is a Toyota, yeah. So these guys do produce a lot of vehicles. Now they tend to separate this data so that they get a clearer picture of where the economy is generally headed to. Now the services PPI data, excluding international transportation, rose 3% from previous year. So we can see that the vehicles did take a beating in terms of being sold by 0.1% compared to last year, but you still would want to look at the two pieces of information. Now, this is the data that was released once again at exactly 8:50. That was 2:50 a.m. local East African time, Nairobi time to be specific. Now, if you look at the data, developments in price index. Now, this is a graph showing you ever since 2018 to where we are currently at the moment. The PPI numbers, all commodities, has been aggressively climbing ever since the pandemic, which was during COVID region, whereby we were down almost 100. Now we are up more at close to 127 currently at the moment. Now the Services Producer Price Index, all items excluding international transport, which is going to be the slightly lesser shade of the black graph that we are seeing here. Now the Services Producer Price Index, all items and all items excluding international transportation, usually follow each other hand in hand. But looking at all commodities, the Japanese economy is firing on all cylinders ever since the pandemic region, and you anticipate. Now this data is very important because as a result of this piece of information, Tokyo, Japan, a leading indicator of Japan's service sector, hit almost 3% in May. Data showed on Wednesday, keeping alive expectations of further interest rate hikes of the central bank. Now, this is why we will want to pay attention to this information, because if this data comes out higher, this will prompt the Bank of Japan to start raising rates higher. Now, last year we did see Bank of Japan hiking their interest rates, whereby we did see the unwinding of the carry trade, which was quite interesting, noting how money moved back into the economy. And we might anticipate the Japanese yen gaining strength even further if this data continues to come out positively the way it has been happening currently of late. Now, the service sector inflation is being closely watched by the Bank of Japan for clues on whether prospects of sustained wage gains will will produce firms to continue raising prices and keep inflation sustainably around its 2%. Once again, the purpose of a central bank is to maintain full employment and inflation below the 2%. The May year-on-year gain in the Services Producer Price Index is an index which measures the price companies charge each other for services, followed a revised 3.4% increase in April. The Bank of Japan did show. Now, once again, this information is very, very important, because when you look at Toyota are going to ask other manufacturers to, let's say, for example, if you have been in the automotive sector, you can see that, let's say, for example, Toyota is going to ask Nissan. Nissan is one of the manufacturing companies in Japan, whereby they're going to ask them to produce some of the goods that they use to make their vehicles, because Toyota does not produce 100% of the parts that they use to make their vehicles. Now, if this data comes out positive, it means that, okay, the interaction between manufacturers in Japan is headed in the right direction. Now, if there is that cohesiveness that we are seeing in terms of these people coming together, whereby the goods and services that they are producing, especially the services that they're interacting between each other, it means that yes, money is moving in that specific economy. This translates to a higher or a stronger Japanese yen in the near future. And if you're looking at the charts as a trader, that shows you that, okay, could this mean that we might be looking at more long opportunities on the JPY? And we shall look at the Nikkei 225 in just a moment's time, but this is a very, very leading indicator of how the economy is generally doing. Now, today at exactly 4:30 a.m., Australia did release their minutes that they had on the previous meeting. Now, this is very, very interesting when you're looking at the minutes. Now, once again, there is a difference between the minutes minutes and the speeches itself. Okay, so when you're looking at the minutes, you're looking at the previous minutes. Now this was the data that was released. Now this is the official minutes that was released at exactly 4:30 a.m. today Nairobi time, and as you can see here, the bar is red, meaning that we are anticipating high volatility. And let's look at what these guys talked about in the previous meeting, which was held in Sydney between the 11th and 12th of August 2025. Now there were members who were present. The chair is Michelle Bullock. Okay, now there are other presents. Now we want to sift through the data. You don't have to read through everything. That's why I'm here to help you. Now looking at the members commenced the discussion of international financial conditions with the observation that prices of risky financial assets had remained buoyant despite continued elevated uncertainty over future tariff policies. And this is quite interesting because when Trump did take office in January officially, there were uncertainty about, okay, what will the impacts of tariffs have on other commodities, on other countries. And this was uncertainty that the markets were like, okay, should we brace ourselves? But moving over this document, we want to look at, so this was the findings, this was the financial conditions, whereby when the meeting does start, they look at, okay, where are we currently at the moment? Now, the members noted that the easing of monetary policy in Australia had also been affected, affecting other determinants of domestic financial conditions as expected. The decline in the cash rate had been passed through the interest rates for households and businesses. Now, looking at it through this information, you will want to look at, okay, the most important part of this document is considerations for monetary policy, whereby turning to considerations for the monetary policy decision. Now, remember, they did cut interest rates. When you're looking at this data, you want to know why. Why did they lower interest rates? Now, the first one, inflation was forecast to return sustainably to the midpoint between the 2 to 3% target range over the forecast period, and conditions in the labor market were expected to be close to balance over that time. Members noted that the downward revision to the assumption for medium-term productivity growth was judged not to have implications for the degree of inflationary pressure, and hence for the stance of the monetary policy. Now, if you look at these, members noted that the output growth. Members agreed that the information received since the previous meeting had been provided the further support that they had been seeking. Keyword here, support that they had been seeking for the judgment that inflation was heading sustainably towards the midpoint of the target range, which once again, it's between the 2 to 3%. Now, once again, members agreed. You see? So when you're looking at these minutes, these people are in the right table. They are on the same table in terms of, okay, inflation is headed towards the right direction. And the purpose of a central bank is to maintain full employment, number one, full employment. Number two, maintain inflation between the 2 and 3%. Now, whenever they do that, they go back to where we call the R star. So for the United States, it's noted as the R star, whereby it's a perfect balance between, it's neither too high of interest rates, it's neither too low of interest rates. Now, looking at it currently at the moment, members also agreed once again, based on what they knew at the time of the meeting, preserving full employment while bringing inflation sustainably back to the midpoint of the target range appeared likely to require some further reduction in the cash rate over the upcoming year. Keyword here is over the upcoming year, meaning there still could be more where that came from. They also agreed that it was important for the pace of the decline in the cash rate to be determined by the incoming data on a meeting by meeting basis. Now, what is some of these data that the central banks usually look at? Number one, employment. So they look at employment data. How many jobs were created in the past months? How is the unemployment rate looking currently at the moment? And what is the average hourly earnings that they are paying these people? Now, that is usually the first data that the central bank usually look at. And then the next data they're going to look at is inflation. Now, inflation, we do have the consumer price index and we do have the producer price index. Now, currently at the moment, before the RBA, which is the Reserve Bank of Australia, did lower their cash rate, they were looking at this data, and yes, they did come into a conclusion whereby in assessing the likely pace of reduction in the cash rate over the period ahead, members noted several considerations that may warrant a gradual pace being adopted. Keyword here is gradual pace being adopted. That various indicators suggested that labor market conditions remained a little tight. Yes, they did identify that. Okay, we are headed in the right direction, but are we there yet? Okay, and the forecast for inflation was for it to be marginally above the midpoint of the target range in the medium term. In addition, private demand was showing signs of recovering, with the risks on both sides of the forecast and uncertainty about the degree of spare capacity and the neutral interest rate could warrant measured approach to assess what incoming information reveals about these and other uncertainties. Now, the decision key here, keyword the decision. Okay, so the decision, the board decided unanimously to lower the cash rate by 25 basis points. And if you go back to the economic calendar, yes, the Reserve Bank of Australia on the 12th of this month did lower the interest rates, and this is the data, this is the exact document that led them to unanimously say, okay, we are going to reduce the cash rate down to 3.6, sorry, percent. Now, assessing the RBS government bond holdings, this is the entire document, but the most important thing here that you'll want to look at is the decision. Now, this was the minutes that was released today at exactly 4:30 a.m. in the morning, and this is quite interesting to know where the markets could be headed to. Now, looking at this piece of information, you will be anticipating, okay, in the near future, we might anticipate more interest rate cuts. What does this mean for the Australian dollar? Now, remember, interest rates are a very key tool that the central bank uses to maintain the currency, the strength of an economy. When they lower interest rates, basically they're encouraging borrowing, they're encouraging spending, they're telling clients, they're telling citizens, go to the bank, take out loans. Loans are going to be much cheaper for you. Now, the central bank does this to stimulate the economy. If they feel like inflation is coming down too much, and inflation, very low inflation is not good. When you have inflation so low, it means that money is not moving at all in an economy. Now, if they say it's heading drastically below the 2%, they would lower rates to stimulate the economy, discourage investing, but at the same time, they would encourage borrowing. Now, if the central bank does say that, okay, inflation is too high, what they'll tend to do is they will increase rates. Now, when they increase rates, it means that they are encouraging investing, but at the same time, they are discouraging borrowing. Now, it's the purpose of a central bank, because remember, once again, why would we want to focus on the central banks? As per the theme, as per the title of today's morning market call, it's central banks frenzy. Now, central banks usually are the top. If you look at forex participants, basically at the top of the pyramid is the central banks. These are the people who control the monetary policy of any economy in the world. And if you feel like, if you look at the economic calendar and you see that, okay, there is anything to do with the central bank, as a trader, it's always advised to pay attention to what this information is going to mean, because there's a high likelihood it's going to affect prices. Which brings me to the next Fed central bank talk, which was exactly 6 a.m. in the morning. And this is a very interesting story, whereby we did have Fed Cook releasing her speech. Now, she is a very nice lady, and she did take office on May 23rd, 2022, to fill an expired term extending January 31st of 2024. Dr. Cook was a professor in economics and international relations at Michigan State University. She was also a research associate at the National Bureau of Economic Research. Now, Lisa released a speech today, and it came at a very critical time, because Mr. Donald J. Trump said, I'm firing you. So Trump says he's fired Federal Reserve Board member Lisa Cook. Why? The president announced Cook's removal from the Fed board in a letter posted to Truth Social. So it was a letter posted to Truth Social that accused Cook of making false statements on mortgage documents, actions he claimed were gross negligence and potentially criminal. Mr. Donald J. Trump had previously urged Cook to resign. So he has been pressuring Dr. Cook to resign, but leading to the economists to say she had no intention of being bullied to step down from her position because of some questions raised in a tweet. Now, when you look at the central bank are supposed to be independent of politics. They are supposed to operate on, they are basically protected against the government. Now, Trump has a very key role in appointing these people, but when it comes into firing these people, that's when some of the lines are being drawn, and they do have protection. When you look at where we've been from, especially the bromance between Mr. Trump and Mr. Powell, whereby Mr. Trump has been urging Jerome Powell to lower interest rates for quite some time right now, but Jerome Powell technically is under an umbrella, is under protection from Mr. Trump, whereby Mr. Trump cannot fire anyone from the Fed Reserve. But today morning, after Cook released her speech, Trump tweeted the move whereby basically he dismissed Dr. Cook from her position. And the move is an early test of Mr. Trump's power to terminate members of the Fed Reserve. Now, when you look at Jerome Powell, his term is supposed to end early next year. And we do anticipate there were talks about he has lowered, he's come down to at least, he's narrowed his search down to 3 names. He hasn't mentioned the names of the potential people who are supposed to replace Mr. Jerome Powell come early next year. But at the moment, we are seeing the test of Mr. Trump's power to terminate members of the Fed Reserve under federal law. Now, Fed board sorry about that. Now, Fed board members, they do serve for 14-year terms and can only be fired by the president for cause, okay? For cause, keyword here is for cause. Mr. Trump cannot just fire anyone from the Fed Reserve just because he feels like, okay, you need to be fired. Cook has served on the Fed since 2022, and her current terms run until 2038. Quite interesting. Mr. Trump wrote in a letter to Cook, I have determined that there's sufficient cause to remove you from your position. And this was just after she was releasing her speech. In a statement, Cook's attorney provided to the New York Times later Monday, she said, I will not resign. Very, very interesting to see in the financial markets. The statement said that there is no cause under the law for Mr. Trump to fire her. Attorney Abe David Lowell said that they will take whatever actions needed to prevent Cook's firing, the New York Times reported. Now, CBS News has reached out to the Fed for comment. What are the President Trump's allegations against Lisa Cook? Now, the allegations against Cook were leveled earlier this month by Federal Housing Finance Agents Director Bill Pulte, who has positioned himself as an ally of Mr. Trump. Pulte sent a letter to Attorney General Pam Bondi accusing Cook of taking out mortgages for homes in Michigan and Georgia in 21. So they are digging up old graves and telling banks in both cases that she planned to use their homes as her primary residency in what Pulte alleged was a fraudulent attempt to gain more favorable lending terms. Last week, Mr. Trump did post on Truth Social, Cook must resign now. Now, Cook, in a statement released through the Fed, I do intend to take any questions about my financial history seriously as a member of the Fed Reserve, and so I am gathering the accurate information to answer any legitimate questions and provide the facts, okay? Now, the story continues more. Pulte has also made mortgage fraud allegations against California Senator Adam Schiff and New York Attorney General Letitia James, 2 Democratic officials and Trump foes who denied their accusations. Once again, keyword here is Democrat officials and Trump foes. They don't like Trump and Trump doesn't like them, okay? Notably, James' office sued Mr. Trump and his company for loan fraud before his return to the White House, securing an almost $400 million civil court judgment that was tossed out by a New York state court last week. Now, why is the president angry at the Fed? Now, Cook's firing came after Mr. Trump spent months attacking the Fed Reserve and its chair, Jerome Powell, over the central bank's handling of interest rates. Now, Mr. Trump says that for every point it's being raised, the country is losing at least 37 billion in terms of paying. Now, when the Fed does lower the interest rate, it means that the loans that the United States currently have, it's going to be cheaper for them to pay off. Now, the United States has a loan of around $37 trillion, which is quite a lot. And Mr. Trump does feel that if we do lower rates, it means that we are going to be in a much better position in terms of paying off our loans currently where we are. But on the other hand, Mr. Jerome Powell feels like, okay, if we do cut rates aggressively currently at the moment, then this could undo what we've been trying to do ever since COVID, whereby we've been trying to maintain the economy, stimulate the economy, but at the same time keep inflation down at a presidential level between the 2 and 3%. Now, Cook, Powell, and 10 other officials sit in a committee that controls the nation's monetary policy. Basically, these are the people who own the keys to the printing machines of the dollar and sets targets interest rates with a dual mandate of keeping inflation low and employment levels high. This work is typically done independently with little to no input from political leaders. But where we are currently at the moment, we are seeing Mr. Trump having a very big hand into what is happening currently at the moment. We did see Mr. Trump firing one of the leaders in the BLS because of the data that was released this month, whereby the NFP numbers were revised drastically down to 14,000 jobs, and the current numbers of jobs created last month was 73,000. And Mr. Trump was like, "I'm not taking any of these anymore. You guys need to go home." And Mr. Trump is exercising his power in terms of letting these people know that I'm not here to joke. We need these rates low. We need to pay off our loans. And but at the same time, the Fed has a dual mandate. And their dual mandate is what? Keep employment high but inflation below the 2%. Okay, the Federal Reserve did hike interest rates to decade-long highs in 2022 and 2023. This was after the COVID, the pandemic, in a bid to quell inflation. After some cuts last year, the central bank has chosen to leave interest rates relatively high compared to other countries. Currently, at the moment, the United States is the country that has the highest interest rates in any nation at the moment, fearing that inflation could come roaring back, or that Mr. Trump's tariff strategy could cause consumer prices to jump. Now, remember once again with the tariffs, when Trump did take in office earlier this January, he did mention about impacting tariffs into most of the economies. Now, when there are higher tariffs, it means that goods and services will be much more expensive, and this cost usually is passed down to the consumer. And the consumer is the leading indicator of inflation. If the citizens are not spending money in a country, it means that money is not moving. Now, the high tariffs, the reason why we have seen the tariffs and everything else have an impact on why the Fed Reserve has delayed to cut interest rates is because of they do fear that, okay, if we do cut rates now and then inflation starts to pick up as a result of the tariffs, then we could start undoing what we've been trying to achieve ever since the pandemic era. Now, the trade-off is that higher interest rates can lead to slower economic growth, and they make it more expensive for American consumers and businesses to borrow. Remember, when you're looking at the United States of America, this is a country that is built on debt. Now, if they do have debt available to them, then it means the economy is generally doing well. If you look at how they like to spend money, the United States is more of spend more money, make more money. Okay. Now, if credit is going to be available at a cheaper price, then it means the economy generally will be headed in the right direction. Now, Mr. Trump has lashed out over this strategy, nicknaming Powell Mr. Too Late. The president has floated the idea of firing Powell, in some cases accusing him of mismanaging a project to renovate the Fed's headquarters. And this was quite the interesting interaction that we saw between the two people, whereby Mr. Donald J. Trump did go and investigate what are these buildings, and the buildings were close to $3.2 billion in terms of renovation, which is quite interesting. And Powell hinted last week that interest rate cuts could be on the horizon. This is why we did see a lot of volatility, especially after 5 p.m. on Friday local East African time, as the Fed tries to prevent inflation from spiking without triggering higher employment. During a speech in Jackson Hole, which did conclude last week, it did start on Thursday, Friday ended on Saturday. The Fed said we will proceed careful. Keyword here is proceed careful, but recent shifts may warrant adjusting our policy stance in the near future. Even without firings, the president could reshape the Fed board as positions open up if the Senate confirms Mr. Trump's replacement for Cook and another Biden nominee who stepped down early. One of the four of the Fed's 7 governors will be Trump appointees, making up most of the Fed boards of governors and 1/3 of the 12-member interest rate setting Federal Opening Market Committee. This is essentially what Mr. Trump will want. Have his own people at the Federal Reserve, so that whenever he says we want to hike rates, there's a high likelihood they are going to follow suit. If we want to cut rates, but remember once again, the Federal Reserve is independent of political inflation and This is going to be quite interesting, noting what's going to happen, especially in the near future. Now, why is this important for us traders? Because it's going to create volatility. Now, what is volatility? It means that there's going to be more probabilities for you as a trader to make money. Remember, once again, there's only one broker in the world. HFM do offer the best products in the world. We do have the best liquidity providers in the world. And go over to the HFM website. We do have almost 5 accounts that you can be looking at. And if you can just look at them currently at the moment. When you go to trading, we do have the center account, the zero, we have the pro plus, and the premium account, meaning you have any account that will suit your trading style. Moving over to the day, we did have unemployment data coming off for Finland. Now, Finland is part of Europe. Yes, it's good to look at this data, but is it worthwhile? Because Finland comprises less than 2% of Europe's GDP, but the data did come out actually higher than anticipated, where unemployment rate did jump from 9.3% previous month to 9.6% right now where we are. And this is the data that we have been seeing. Unemployment in the Finland region has been going to the upper side. Now, this is data of people aged between 20 and 64 years of age. Basically, these are the people who are the energetic workforce. These are the people who usually are the middle income over society. And you'll want to look at the data. The data of employed persons was 2.637 million, and that of unemployed persons was 269,000. There were 35,000 fewer employed men and 7,000 fewer employed women than in July 2024. Now, whenever you're looking at this data, usually it reflects to 1 year ago, where we are currently at the moment and where we were 1 year ago. So currently at the moment, there are 35,000 fewer jobs in terms of men and 7,000 fewer jobs in terms of women than compared to July 2024. The trend of employment rate among persons aged between 20 and 64 was 75.8% in July 2024. 2025, sorry, and the trend of unemployment rate among persons aged between 15 and 74 was 9.6% in July. Now, the number of employed people once again did fall from previously last year. When you're looking at Finland, Finland does have less than 2% in terms of the overall GDP, but it's usually good to look at the data in terms of how is this going to affect neighboring countries. Now, when you're looking at Euro, the big participants are usually Spain, Germany, France, Netherlands, and the likes. But it's also good to look at other people who are included in the Euro region. Now, later on in the day, sorry, before we go there, France has just released their consumer confidence for August numbers, which came out at exactly 9:45 a.m. today, whereby the numbers was revised previously from 89 to currently 88. We were forecasting a 90, but the data actually came out lesser than anticipated, which did come out at 87. Trying to look at that piece of information. Let's see if it has been updated. Okay, still not yet updated, but we shall look into that data as time goes by. But looking at the graph currently at the moment, the graph has been going to the downside ever since I've lost my piece of information. Where were you? Okay, here you are. Let's wait for it to load. Okay, so this is the actual and deviation history. Looking at 2022, we have been playing around this region. Now, consumer confidence is very important. It is very important because when consumers have confidence, when you look at France do produce a pretty decent goods in terms of luxury goods, especially. If they do have confidence into how consumers are buying their products, it means that the economy generally is anticipated to be headed in the right direction, because consumers account for a majority of overall inflation. If people in a particular economy are not buying, it means money is not moving. Okay, once again, if people in a particular economy are not buying, it means that money is not moving. Now, consumers rate businesses conditions, labor market conditions, and prospects for jobs and income growth. Remember, these companies usually hire workers. Okay, now if the consumer confidence comes higher than anticipated, it means that, okay, there are going to be jobs that are going to be created because the products are going to have a demand into how consumers want to buy them. But if the data comes out lower than anticipated, you're like, okay, we were anticipating goods to be to be bought at a certain level, but at the moment we are like, okay, things are not headed in the right direction. Now, for you as a trader, you will want to look at this information because this is going to impact the weight of the euro currently at the moment, and we shall look into that. Now, today in the evening, we do have Richmond Fed Manufacturing Index, which once again is a leading indicator of how the economy health is doing currently at the moment. Now, this is going to look at a few companies, which is going to be 220 business organizations, 220 big companies in the Richmond area, whereby the industry inflation can be seen from the survey. Generally speaking, a high reading is seen as bullish for the dollar, whereas a low reading is seen as negative for the United States dollar, whereby they're going to ask these 220 businesses, how do you feel about the relative level of business? Are you guys having products? If you're having products, are you selling the products? Now, if at all you have these products, are you hiring more people or are you letting off people? Then this information will be reflected into prices. Okay. Once again, a high reading is usually seen as a bullish reading for the dollar, whereas a low reading is seen as negative for the bearish dollar. Now we are looking at negative 17. If the data comes out lesser, because this is a negative, or actually comes out greater than 17, it means that the economy is generally headed to the right direction in the long run. We are going to conclude by Bank of Canada Governor McLean's speech. Now, this is very, very important, whereby we will want to listen to what the head of Bank of Canada Central Bank, Tiff McLean, was appointed. What does he have to say? He has a 3-year term, effective 3rd June 2020. As governor, he's also the chairman of the board of directors for the prior to being appointed as Bank of Canada chief. Where was it? McLean served as a dean of the Rotman School of Management, University of Toronto for 6 years. He had already served as senior deputy governor of the Bank of Canada from July 2010 until May 2014. McLean was also the first chair of the Financial Stability Board Standing Committee for Standards Implementation from 2009 to 2013 and represented the Bank of Canada at the SFB. This is the person who has the keys. Technically, he's the highest person in terms of the Bank of Canada, whereby if he does say we are going to lower interest rates will be lowered. If he does say we are going to increase interest rates shall be increased. Now this has an impact into how prices are going to be moved, because investors, if you look at it from this perspective, for us traders, you would want to foresee what could happen in the near future. And this is the best thing about being a trader. You look at probabilities, you ask yourself, what are the chances that this guy's speech, if it comes out positive, it means that the Canadian dollar will be positive in the long run. If it does have a negative tone to it, it does mean that, okay, in the near future, we are anticipating selling opportunities on the Canadian dollar. For us traders, this is most important things to do each and every day, and it usually starts with the economic calendar. This is something that is available to you for free. Once again, you don't have to pay a single shilling, but with this information can enable you look for high probability setups in the financial markets, which is going to bring me to the next segment, which is going to be trading, which is going to be the charts essentially. Okay, so I'm a pop-up trading viewer. We have just started a segment of I would want you to interact with me. What pairs would you want me to be looking at? If you have any pairs that you would want me to look at, currently put it in the chat box and I'll be glad to dissect the data for us all. Okay. Remember, once again, my purpose is to help you look for high probability setups, but this is not financial advice. Okay. Now, looking at gold, we have been trending to the upper side. This was when the tariffs were at its peak. Essentially, we did enter into a period of consolidation for quite some time. This was almost 130 days, if I'm not wrong, 132 days to be exact, whereby prices has just been consolidating. And the price point of which gold has been consolidating is very interesting. If you look at prices, did maintain around the 3,300 region for quite some time, quite some time, if you do identify it. And this is what you call a psychological key level when you're looking at the financial marketplace. Okay. Now, this was back when this was August 1st, where my cursor is currently at the moment. We did receive bad data for NFP numbers this month, and gold looked at this data very positively, whereby you're like, okay, the United States in America, they're not creating as many jobs as we anticipated, and Gold was like, let's push to the upper side as a result of that negative data. We did look at the commitment of traders report, whereby ever since 9th of August, which is somewhere around here, let's say ever since 8th of August to 12th of August, we did see institutions offload almost 9,000 positions on the commitment of traders. Now, this was the result of the retracement we did see on gold. Now, prices came back to a region of interest, back to this order block. This was the last candlestick before the move to the upper side, whereby we do believe that this is where institutions added more position. Now, prices came back, retested that region, which formed as support. Now, prices rallied to the upper side. This was Wednesday, consolidated around this region. And I remember during the previous morning market calls, we were looking at this region of resistance and this region of support. Now I'm looking at the H4 time frame. If I can go down to the 1 hour time frame, as you have noticed, whenever I'm doing analysis, I usually start from a higher time frame, moving down to a lower time frame to get the overall perspective of where the trend is headed to. Now looking at this information, prices rallied to the upper side, came back down, formed support on the 21st of August, push to the upper side. Prices struggle. Looking at this price action, you can see that the candlesticks had more prominent wicks to the upper side and lower side compared to the bodies. This means that prices are really struggling to move to the downside. Bears are really struggling to push to the downside. We did have region of support tested once more for the third time. We did have this manipulation here, whereby there was liquidity that was raided as a result of this order block. We can consider this as an order block once again at exactly 3 p.m. Then during New York Open, we did have prices pushed to the upper side, whereby we did have this bullish engulfing candlestick. Then the speech of Jerome Powell, which did occur at exactly 5 p.m., whereby we had this massive bullish candlestick, which broke the most recent region of resistance, which came back to be tested as support. If you can see here, being tested beautifully once again as support. And then we had some bullish presence once again yesterday during New York Open. Now looking at the current price action at the moment, candlesticks are printing side by side, which means that the market are now waiting for the next probable move to the upper side or to the lower side, depending on the trigger that we are anticipating. But if I can just identify, that's the most recent region of resistance that we can be looking at currently at the moment. Now prices are currently in a new trend. What do I mean by a new trend? Let me move this one here, whereby prices did shift. We did form a higher high. This high broke the most recent high over here. Prices retraced to form another higher low. This high broke the most recent higher high to form a higher low. Now the markets have broken the most recent higher high, possibly to form a new higher high, and we might see a short-term retracement for a further continuation to the upper side if the data continues to come out positive for the precious metal. But at the same time, we are anticipating negative data for the dollar in the near future. If at all we do see interest rate cuts in the near future, then this means there's a high possibility prices will continue moving to the upper side. Now, if prices do break to the upper side, the next question could be, what could be the next region of interest for us as traders? Now, this is whereby you bring upon psychological levels. Now, we have been trading around the 3,330 region for quite some time. 3333. Very interesting. Now, if prices breaks that region, the next region that I'll be looking at is 3,400. Now, psychological levels is these are round numbers, because whenever you're looking at charts, we traders believe that it's easier dealing off round numbers compared to, let's say, for example, it's easier to trade at 3,400 compared to 3,389 or something. Okay, so if prices do breaks regions, the next probable region that we might anticipate, and if you look at the previous data to the left hand side, 3,400 is a very interesting region, whereby we did have prices consolidating for quite some time. For quite some time. Where's my measuring tool? Okay, for like 9 days, 11 hours, we did see prices consolidate for 125 hours. For 125 hours, prices consolidated. We did tap into the 3,400 region, and this could be the next possible target in the near future for the precious metal. Now, looking at silver, silver has been behaving more in terms of making higher highs, higher lows, higher highs, higher lows. but we will want to see how this information is going to affect the data in the near future. Now, if I can look at this information, if I pull my Fibonacci from this low to this high, we can see prices has respected the 50% region, which is quite interesting. Huh? Quite interesting to note that the 50% region has been respected on the Fibonacci, and we might anticipate that prices will continue moving further to the upper side. If at all prices, you can see this candlestick did close exactly above the 50% region on the Fibonacci, meaning we might anticipate pricing moving further to the upper side if we do close above this region of resistance around $38.72 an ounce on the silver metal. Now, looking at the dollar index had a sharp down downtrend. This was as a result of the Fed speech. Now, we did leave a lot of inefficiencies. Sometimes the market will completely retrace on that initial move. Sometimes we might anticipate a retracement on the Fibonacci level. Now, looking at the dollar index did come into a very interesting region. We can consider this the order block. It doesn't have to be precise, but if you can just draw my zone on the wick of that candlestick. As you can see here, prices came back, retested that order block. This was the last bullish candlestick before this massive trend to the downside, and we'll want to see how prices are going to react in the near future, whereby we do have relatively equal highs at around 98.53. Remember, as a trader, you will want to react to prices, okay? And once again, a quick pointer is that this is the final trading week of the monthly candlestick, and you'll want to be very careful. You will want to be very careful because this is the final trading week of the monthly candlestick. Now, looking at the S&P 500, we are currently retracing. We'll want to look at regions of inefficiencies, and the region of inefficiencies that I'll want to look at will be around this region here. This zone is no longer valid for me because prices is currently in between that region. We did form this consolidation after the move to the upper side. We are currently retracing, and as you can see, there is a saying that bulls take the stairs and bears go out the window. If you do invert it, this could have a very deep meaning to it, whereby whenever prices are pushing to the upper side, on this particular case, we did have massive momentum to the upper side. Now prices are correcting to the downside slowly by slowly. Looking at the Dow Jones, once again, we did have this region of resistance that we were looking at, and the market did break to the upper side, came back down, retest on that region. We are currently we are currently at the inefficiencies region. Now, whenever you're looking at indices, they are positively correlated. You can see US 30 has not filled in the gap, but if you look at US 30, we are currently in that gap. So sometimes if one doesn't, usually there is a high likelihood the other two, including the Nasdaq, is going to fill in those inefficiencies. So once again, the equities do thrive on lower interest rates because technically they are going to be much more cheaper for these companies to borrow loans, which is going to have an effect on prices in the near future. Okay, so let's go to Russell once again, medium 2000 medium cap stocks. We did break this region of resistance above this region. We are currently forming relatively equal lows. If we do have support forming, this was once resistance which was broken, could be support in the near future. We'll want to see how prices are going to react as time moves on. If you do have candlesticks that close to the downside, it means prices, there's a high likelihood that we might come back to these regions of inefficiencies around this region. So we'll want to see how prices are going to react to that point. But on the other hand, if we do have candlesticks that close above this region, then this means that we might go back to this region of resistance around 2,368 in the near future. Okay, the FTSE, which is the UK 100, currently once again did break to the upper side. We are coming back down. Could this region around 9,200 act as a region of support for a further continuation to the upper side, whereby we might anticipate more long opportunities in the near future. Now, looking at Brent oil did break out of this consolidation that we were looking at. This was quite interesting, and we did break out of the $66.7 a barrel region. Currently, we are trading around the $67.7 a barrel region, and we'll want to see now for energies. So let's look at natural gas. Where are you? So there are some commodities, huh? And with commodities is basically supply and demand. Let me start from a daily perspective. Okay, not a weekly, but a daily. Now, when you're looking at commodities, one thing you need to ask yourself, seasonality speaking, where are you currently at the moment? Seasonality speaking. Now, when you look at natural gas, there's a comment from Gainey 2000 who asked for me to look at natural gas. When you're looking at commodities, the first thing, as mentioned, you look at seasonality. Ask yourself, where we are currently at the moment, how's the supply and demand basically looking like? When you look at countries like the United States of America, right now it's summer. So when it's summer, there is less energy that is used. But when you head towards winter, which is going to be in the next few months, they use more energy to heat up their homes, because it gets cold. And for some of them, they do spend much more. The demand for natural gas usually peaks towards winter. Why? Because now more homes are going to be interested in heating their homes using natural gas or energy. So technically, when you're looking at energies, seasonality speaking, that should be the first one. Okay. Then supply and demand. Currently, at the moment, do we have any factors that is going to influence the prices of natural gas? Now we are looking at natural gas in United States, but this could also have an effect on Europe. When you look at what happened between Russia and Ukraine, when Russia invaded Ukraine, there was a lot of sanctions, and at least 20 to 26% of energy that Europe consumes comes from where? Comes from Russia. So when there were these sanctions, the prices of the commodity went to the upper side. So you ask yourself also, once again, you start with fundamentals. When you're trading commodities, look at the basics. Before you go over to the technical analysis, ask yourself these questions. Seasonality. Yeah, so that's it basically when you're looking at natural gas. Now, looking at where prices are currently at the moment, we are back down to 2.689. Looking at current price action, seasonality speaking, we might start seeing pricing move to the upper side. If at all, winter does come in, and then we might see the commodity pricing actually move to the upper side in terms of supply and demand. That's going to be it for me. I don't see any more questions. See you in the next one. Take care of yourselves. Once again, risk management is going to be crucial for you to survive in the markets for long run. Stay safe. Take care.